Hey everybody. Today we will begin an interesting discussion on history. I am ready. You are not a customer anymore. You just don't know it yet. Every morning, millions of people walk into a coffee shop, tap their phone on a reader, and buy a cup of coffee. It feels like the most ordinary transaction in the world. A product exchanged for money. Commerce at its most basic. But the money that paid for that coffee was not transferred at the moment of purchase. It was transferred weeks or months earlier when the customer loaded funds onto an app. It sat in a corporate account earning returns for a multi-billion-dollar corporation before it was ever exchanged for a single espresso shot that coffee company Starbucks currently holds more money in. Customer deposits on its app than many mid-sized regional banks hold in customer accounts. Let that settle for a moment. A coffee company holding more deposits than a bank. Starbucks does not have a banking license. It is not regulated by banking authorities. The money sitting in its app is not insured by any government deposit protection scheme. And if Starbucks were to file for bankruptcy tomorrow, every customer with a balance on that app would stand at the back of a very long line of creditors, holding a claim worth whatever the bankruptcy proceedings determined, which, in most cases, means a fraction of what they deposited paid out over years. This is not an anomaly specific to onecoffeecompany.it is the defining financial architecture of the modern consumer economy, and it has been constructed so gradually, so seamlessly, and so cleverly embedded in the experience of ordinary life that almost nobody noticed it happening. Today we notice it. Part 1. The Coffee Shop Vault, the Starbucks Anomaly. In 2022, Starbucks reported that its loyalty program held approximately $1.6 billion in customer deposits, $1.6 billion sitting in a corporate account, belonging legally to customers who had loaded money onto an app to buy coffee. For context, there are hundreds of federally chartered banks in the United States that hold less than $1 billion in total deposits. Starbucks, a company whose stated business is selling beverages, operates a deposit-taking operation larger than a significant portion of the American banking system. To understand how this happened, you need to understand the architecture of the Starbucks app and the financial logic that makes it extraordinarily profitable independent of anything the company sells. When you load money onto the Starbucks app, you are not prepaying for coffee in any meaningful financial sense. You are making an unsecured, zero-interest loan to Starbucks Corporation. The money leaves your bank account immediately. It enters Starbucks corporate treasury immediately. Starbucks can invest that money, use it for operating expenses, or deploy it however its treasury department determines is most profitable. You receive no interest. You receive no return of any kind on the capital you have provided. In exchange, you receive points, stars, a promise that future purchases will be slightly discounted, that a free drink will eventually materialize after sufficient spending, that membership in a tiered loyalty structure will unlock marginally better treatment at the counter. You have provided capital. You have received a marketing program. Now introduce the concept of breakage. Breakage is the industry term for loyalty program balances that are never redeemed, money loaded onto apps that is forgotten, points accumulated and never spent. Gift card balances that sit unused until they expire or are written off. In 2022, Starbucks recognized approximately $196 million in breakage revenue. That is money that customers loaded onto the platform, never spent, and which Starbucks was legally entitled to keep after a specified period, $196 million in a single year from money customers deposited and forgot. This is not incidental to the Starbucks business model. It is a designed feature of it. The friction between depositing money and spending it, the psychological distance between loading an app and making a purchase, the complexity of point systems that make it difficult to track the actual value of accumulated rewards. All of these elements increase the likelihood that a portion of every deposit will never be redeemed. The coffee is the delivery mechanism. The float, the invested deposits, and the breakage, the unredeemed balances, are the financial engine, and Starbucks is simply the most visible example of a structure that exists across virtually every major consumer brand operating in the modern economy. Part 2. The automaker's secret. Debt is a product. To understand how consumer brands became shadow banks, you need to go back to the middle of the 20th century and watch one industry make a discovery that would eventually reshape the entire global economy. In the 1920s, General Motors was a car company. It manufactured vehicles, sold them to dealers, and made its money on the margin between what it cost to build a car and what a dealer paid for it. This is a straightforward manufacturing business. It has real constraints. Material costs fluctuate, labor costs rise. Competition compresses margins. The business of making physical things is inherently difficult to scale without proportional increases in cost. Then, in 1919, General Motors established the General Motors Acceptance Corporation, GMAC. GMAC's purpose was simple: to provide financing for customers who wanted to buy GM vehicles, but could not pay the full purchase price up front. Instead of requiring cash, GMAC would lend the customer the money, secured by the vehicle, and the customer would repay the loan with interest over a set period. This was not a new concept. Installment credit had existed for decades, but what GM discovered over the following years, And what would take decades to fully articulate was that the financing business was structurally more profitable than the manufacturing business. Consider the economics. Building a car involves raw materials, labor, factory overhead, logistics, and dealer margins. The net margin on a manufactured vehicle after all costs is typically in the single digits as a percentage of sale price. Competitive pressure constantly works to compress those margins further. Lending money to buy that same car involves a cost of capital, the interest rate at which the financing company itself borrows, and a lending rate charged to the customer. The spread between those two rates, multiplied across millions of loans held simultaneously, generates returns that dwarf anything available in manufacturing. By the second half of the 20th century, the financial arms of major automakers were generating profits that in some years exceeded the profits of the manufacturing operations they were created to support. Ford Motor Credit, Chrysler Financial, GMAC. These were not ancillary services designed to make car buying convenient. They were profit centers that happened to be attached to car companies. The manufacturing operation became, in a structural sense, a customer acquisition mechanism for the financing operation. You built and sold cars at thin margins in order to generate borrowers for your high margin lending business. This logic, use a product or service to acquire customers, then extract the real value through financing, would eventually migrate far beyond the automotive industry. It would become the template for how the most sophisticated consumer businesses of the 21st century would operate. Part 3. The Tech and Travel Empires. Minting Private Currency. Airlines discovered something in the 1980s that would eventually make their frequent flyer programs worth more than their aircraft. When American Airlines launched the Advantage program in 1981, the first modern frequent flyer program, the concept was straightforward: reward loyal customers with free flights, encourage repeat business, differentiate from competitors. What nobody fully anticipated was what happened next. Airlines began selling miles to third parties. Banks, hotels, rental car companies, and retailers paid airlines for the right to award their miles to customers. A credit card company pays American Airlines a fixed amount for every Advantage mile it awards to cardholders who use its co-branded credit card. This transformed the economics of frequent flyer programs entirely. The airline was no longer simply rewarding loyalty. It was operating a currency printing operation. It created miles at negligible cost, a database entry, and sold them to third parties at a markup. Those third parties distributed the miles to their own customers as rewards. The miles accumulated in hundreds of millions of accounts, creating a liability, a future obligation to provide flights or rewards, but also a float, a pool of outstanding currency that had been sold but not yet redeemed. The float from frequent flyer miles represents billions of dollars in economic value sitting in customer accounts, generating no interest for those customers, available to be devalued or modified at any time by the issuing airline without requiring customer consent. And this is where the private currency aspect becomes legally significant. When a government issues currency, its value is underpinned by the full faith and credit of the state. When a central bank adjusts monetary policy, the process is subject to legal frameworks, political oversight, and public accountability. When American Airlines decides to increase the number of miles required for a free flight, effectively devaluing every mile in every customer's account simultaneously, it requires no regulatory approval, no public notice period, no compensation to affected customers. It simply announces the change, often with minimal advance warning, and millions of customers wake up to find that the currency they have been accumulating for years is suddenly worth less than it was the day before. This has happened repeatedly. Every major airline has conducted what the industry calls award chart devaluations, increases in the cost of redemptions that reduce the value of outstanding miles multiple times over the last 2 decades. The miles are private currency, and the issuing entity retains complete control over its value. Apply the same analysis to technology company payment systems, and the picture becomes even more striking. Apple Pay, Google Pay, PayPal, Venmo, Cash App, these platforms have collectively accumulated billions of dollars in customer balances held within their systems. The money sits in the technology company's accounts, not in Insured bank account in your name. PayPal, as of recent reporting, holds tens of billions of dollars in customer balances. It invests those balances and earns returns on them. Customers earn nothing. The float generates revenue for the platform while customers receive the convenience of not moving money in and out of the system for every transaction. These are not banks. They are not regulated as banks. The money held within them does not carry the protections that apply to bank deposits. They are functionally shadow banking operations embedded inside technology products that people use because they are convenient, not because they understand the financial architecture underlying them. Part for the legal black hole, fictitious unsecured creditor. Here is where the architecture of the shadow banking system reveals its darkest dimension. When you deposit money into a bank account at a federally insured bank in the United States, that money is protected by the Federal Deposit Insurance Corporation up to $250,000 per depositor per institution. If the bank fails, the FDIC steps in. Your deposit is returned. The process is not painless, but the protection is real and legally guaranteed. This protection exists because bank deposits were determined, through painful historical experience, to require government backing to function as a stable store of value. The bank runs of the 1930s, which destroyed 9,000 banks and wiped out the savings of millions of ordinary Americans, demonstrated what happens when deposits are uninsured and confidence collapses. The regulatory framework that emerged from that catastrophe, deposit insurance, banking supervision, capital requirements, was designed to prevent a repeat, and for decades within the traditional banking system it largely succeeded. Now consider what happens when that money is not in a bank account, when it is on the Starbucks app, when it is in your frequent flyer account, when it is sitting as a balance in your PayPal wallet or your Apple Cash account. There is no FDIC coverage. There is no government deposit insurance of any kind. The money is held by a corporation. It is an unsecured liability of that corporation. Your claim on it is governed by the terms of service you agreed to, a document that almost nobody reads, that can be modified unilaterally by the company, and that places you, in the event of the company's insolvency, in the legal category of unsecured creditor. Unsecured creditor is a precise legal term with profound implications. In a bankruptcy proceeding, the priority of claims determines who gets paid and in what order. Secured creditors, those holding claims backed by specific collateral, are paid first. They receive the value of their collateral. The remaining assets of the bankrupt estate are then distributed to other creditors in a legally determined hierarchy. Unsecured creditors, which includes every customer with a balance on a consumer brands app or loyalty program, come after secured creditors, after administrative expenses of the bankruptcy, after certain tax obligations, and often after other categories of preferential claims. In a significant corporate bankruptcy, unsecured creditors frequently receive pennies on the dollar. Sometimes they receive nothing at all. This is not a theoretical risk. It is a documented reality. When Toys R Us filed for bankruptcy in 2017, customers who had gift card balances received nothing in the initial proceedings. When Pier 1 Imports collapsed in 2020, gift card holders were classified as unsecured creditors with minimal recovery prospects. When Bed Bath & Beyond filed for bankruptcy in 2023, millions of dollars in outstanding gift card balances were caught in proceedings that left holders uncertain about recovery. These were retail companies, consumer brands with loyal customer bases, people who had given them money in good faith, expecting to receive products in return. The legal reality is that the money you load onto any consumer platform, any app, any loyalty program, any stored value system operated by an entity that is not a regulated bank, is money that you have lent to that corporation on an unsecured basis, with no government guarantee and no priority claim in the event things go wrong. The financial system spent decades constructing regulatory infrastructure to protect deposits in traditional banks. It has constructed no equivalent infrastructure for the hundreds of billions of dollars now sitting in consumer brand accounts, loyalty programs, and technology platform wallets. That gap is not accidental. Closing it would require these platforms to operate under banking regulations, to hold capital reserves, to pay into deposit insurance funds, to submit to banking supervision. That would make the shadow banking operations significantly less profitable. The platforms lobby against such classification. The regulatory environment has largely accommodated them, and customers continue to load money onto apps, accumulate points in loyalty programs, and carry balances in digital wallets, largely unaware of the legal framework governing those funds. The climax: the system we built ourselves. Step back from the individual examples and look at the architecture as a whole. Starbucks takes deposits and keeps the float and the breakage. Automakers finance their own products at margins that dwarf manufacturing profits. Airlines issue private currency they can evaluate at will, selling it to third parties for immediate cash, while the redemption liability stretches across decades. Technology platforms accumulate tens of billions in customer balances, invest them, and return nothing to the customers providing the capital. Retail brands accept payment in advance, hold it as an interest-free loan, and return a fraction of it in the event of their own failure. None of this required a conspiracy. None of it required a secret meeting where executives decided to turn consumer brands into shadow banks. It emerged through the ordinary operation of financial incentives applied to consumer behavior over decades. Every individual innovation seemed reasonable in isolation. A loyalty program that rewards repeat customers, a financing option that makes expensive products accessible, a convenient app that makes transactions frictionless. The cumulative architecture is something different. It is a system in which every significant consumer interaction has been designed not merely to exchange a product for money, but to capture a financial relationship afloat, a deposit, a debt obligation that is more profitable than the product itself. We think we are buying coffee. We are providing interest-free capital. We think we are accumulating rewards. We are holding uninsured currency whose value is controlled by its issuer. We think we are financing a car. We are becoming a revenue stream for a financial operation that generates higher returns than the vehicles it sells. The greatest financial transformation of the last 50 years did not happen in banks or on trading floors. It happened in coffee shops, airline loyalty apps, car dealership finance offices, and the terms of service agreements that nobody reads. The shadow banking system is not in the shadows. It is in your pocket, on your phone, in your wallet, woven into every transaction of ordinary life, and almost nobody who participates in it understands the legal architecture that governs what happens to their money when the company on the other end of that transaction runs into trouble. Banks are regulated because history demonstrated what happens when they are not. 9,000 bank failures, millions of people losing their savings, decades of economic damage that history produced deposit insurance, capital requirements, banking supervision, a legal framework built on the understanding that institutions that hold other people's money require oversight proportional to the trust placed in them. The shadow banking system that has grown up inside consumer brands over the last 50 years holds hundreds of billions of dollars of other people's money. It operates without deposit insurance, without capital requirements, without banking supervision. It operates instead under the terms of service agreements that govern your loyalty program membership and your app account. The next time you load money onto an app or accumulate points in a loyalty program or finance a purchase through a brand's own lending arm, you are participating in this system. Now you understand what you are participating in. If this gave you a new perspective, subscribe to Economic Chronicles, the hidden architecture of money and power. We show you where to look.